All right, so first I wanted to start by thanking the major contributors to this report. Dick Whitman wrote our foreword. He is a farmer in Idaho and a longtime advisor to EDF of 20 years. He also was a former farm credit lender and part of the Farm Credit Administration, and he's a past president of the Farm Financial Standards Council. So we owe a huge debt of gratitude to him and the other members of our Farmer Advisory Board who have really influenced this work from the beginning. I also want to thank the members of the AGREE Economic and Environmental Risk Coalition, Greg Fishbein of the Nature Conservancy, Laura Sands and others from Keiko ISOM, and Scott Marlowe from Longrose Consulting. They all had really important contributions to this work. So the objective of our Financing Resilient Agriculture report was to provide a compelling case for agricultural lenders to mitigate climate risks and finance more resilient agriculture. And you may ask yourself, why lenders? As we've been working over several years with farmers on the farm financial impacts of conservation adoption, we've found that aside from the farmer himself, the audience most interested in this work on farm profitability, resilience, and conservation is agricultural lenders. They're farmers' closest financial partners. And so as we started to learn more about them and get to know many ag lenders and talk extensively with several of them in developing this report, we realized that you can't ignore the role of agricultural lenders in figuring out how to make the overall agricultural system more resilient to the impacts of climate change. So this presentation is split roughly into two sections, which mirrors the report. First, focusing on the climate risk that faces both farmers and their lenders, and second, on how lenders can take action to finance more resilient agriculture. So first, just to reiterate the climate impacts on agriculture, of which we've seen many examples this year. There's precipitation and temperature variability, storms and fires, and weeds, disease, and pests, and we see these increasing every year. And this is something that, is just something that farmers are going to have to deal with and has very serious financial implications for them moving forward. And because farmers face climate risks, that means that their lenders also are at risk from climate change. And those risks take a few different shapes. One is the physical risks. Farmers lose their crops and are less able to repay their loans. That also creates a problem for a financial issue for their lenders. Second is correlated risks. So lenders are often geographically concentrated and they finance several different kinds of agricultural businesses. And so if you lose that crop production or other types of production, then those businesses are also affected. So the lender could have several different types of loans within their portfolio impacted by an extreme weather event. And last, there's regulatory risk. We'll talk in a little bit about the CFTC subcommittee report, but that very clearly points to an increased role for regulators, financial regulators of all kinds in this area. And that may be a risk if lenders are not prepared, but I think it's also a really good opportunity for lenders to get that preparation to incorporate those risks into their risk management frameworks. So this map just reiterates the point about concentrated risk. Many ag lenders are small, many are geographically concentrated, many are concentrated in agricultural lending or related industries. So there are multiple reasons that kind of build upon each other that make agriculture itself particularly at risk from climate change, and then also the structure of agricultural lending facing increased risk. This was demonstrated by the floods in 2019. Midwestern banks reported to the Federal Reserve that 70% of their borrowers were affected by the floods and extreme rains. And then the region's agricultural loan portfolio had very high rates of loan repayment problems. So at this point in the talk, you might be asking yourself, why isn't she talking about crop insurance if she's talking about risk from weather events? This slide shows where the major sources of indemnity claims. So that bottom bar is drought. You can see drought. And then the orange bar is excess moisture, precipitation of rain. So you can see insufficient or excess water is really driving the losses in the insured portion of agriculture. And that variability is, driving, of course, as you would expect in an insurance market, those indemnity claims up and down. However, while crop insurance is a really important risk management tool for many farmers, it is not sufficient to protect farmers, lenders, or the agricultural economy writ large against climate change over the long term. That's true for several reasons. First, many farmers don't have crop insurance. While we often cite, I cite very high adoption statistics for large-scale grain farmers, up to around 90%. If you look across the country, only 15% of farmers have crop insurance. So there's a gap right there. Second, crop insurance does not make farmers whole, and it was never designed to. The maximum coverage rate is around 85%. And if you're in an area where there's been repeated natural disasters, like I've seen in my home state of North Carolina, the farmer's not getting back up to wholeness, and then, they get hit again. So even if they're using crop insurance, they could get, kind of beat back over time, and their financial position can be degraded. And then, of course, going back to the correlated risk issue, businesses that rely on crop production are not covered. So, the fact that a crop is not produced due to a weather event matters. And the businesses throughout the supply chain are affected, and therefore the lenders that finance them will also be affected. There's also this issue of how climate change could increase the cost of the federal crop insurance program. So the Department of Agriculture's Economic Risk Service did an analysis that showed, depending on the levels of greenhouse gas emissions and associated climate projections and the levels of farmer adaptation, the cost of that crop insurance program could rise between 3% with low emissions and high adaptation to nearly 40% with high emissions and low adaptation. So you can see that both what we do about emissions writ large and also how farmers react to changing weather really will have an influence on the cost of the federal crop insurance program over time. I'm happy to see that, some agricultural lenders are starting to really realize this challenge. And this quote from Tom Halverson, I think is excellent, especially coming after a debate night, showing that concerns about climate change are just now a permanent part of the operating environment in rural America. And so this is not a political thing. This is just reality and risk management that lenders and other pieces of the financial sector will need to integrate into how they operate moving forward. So I'm going to turn to the recently released CFTC report. My colleague Nat Cohan was on the subcommittee that developed this report. It covers the entire US economy, and it's actually very readable, I thought. It does a really good job of linking the physical risks of climate change to the financial market risks, and it has a significant focus on agriculture. And so from that report, I just pulled out a few of the notable things that I think the folks on this call would be interested to see. So one, it recommended increasing research on climate-related subsystemic shocks in the agriculture sector. So they talked about the potential for systemic shocks across our entire US financial system from climate change. But then they also talked about the potential for certain sectors to have subsystemic shocks. So agriculture was pointed out as one area, one sector, which could have subsystemic shocks. They also recommended that government-supported enterprises like farm credit should be assessing their climate-related risks, and it encouraged them to adopt strategies to monitor and manage those risks. And then it also recommended a pilot to do some climate risk stress testing, including agricultural banks and including community banks And I thought this was a really good point. You know, lenders come in a variety of shapes and sizes, and not all of them have the capacity to develop this kind of risk assessment in-house. And so the ability to work with either external providers of risk assessment or potentially have a government role in supporting that function to make sure that those community banks are not left behind in this, I think is really important. So now I'm going to shift to talking about how agricultural lenders can not only assess their own climate risk, but also how they can proactively engage their farmer clients in reducing that risk and building more resilience. So first, I'm going to talk briefly about climate resilient agriculture. So this will look different in different regions, but our report focused on a few common principles that I think are flexible and adaptable to all different regions. So one is building soil health. Another is managing water and inputs more efficiently and effectively. That again, that will look different whether you're in a region that's having extensive drought, not enough water, or if you're in a region where you're having too many flashy floods. But either way, they're important water management actions that can build resilience. And last is to diversify crop rotations and integrate livestock. That builds that portfolio effect across the farm where if you're hit by a natural disaster, you know, one crop may be hit worse than the other, one may be ready to harvest, one may be protected. Also having animals in the mix just allows the farm to not be just relying on one thing for their income for that year. And EDF and many other organizations that we're collaborating with are doing a lot of work to build that financial case for climate resilient agriculture. And what we've seen in our farm budget analyses and also in looking across the work of other organizations is a few key themes around this financial case. So one is the ability to reduce production costs over time. That can come from things like switching to no-till, which has documented cost reductions in fuel and labor and equipment, or from, you know, as you are improving the health of your soils, being able to reduce nutrient use or reduce herbicide use. Another important area is increasing yield stability. This also goes back to the soil health issue and managing water efficiently. And when you increase the sponginess of your soils, that means you're able to hold water when there's not enough and absorb it when there's too much. And we've heard from our farmer advisors that really makes a difference in terms of their crop yields and also their ability to get into their fields at all. And then last is that diversifying revenue. As I mentioned on the last slide, it just gives the farmer more flexibility and ability to mitigate the impacts of shocks on any one specific revenue source. But I think as we all know, there are still real barriers to farmers who want to adopt these practices. There are short-term transition costs, there are risks, and also the learning and time has to be acknowledged. The farmers that we work with have described adopting these practices really as a shift in the whole management system of the farm. So this isn't, you know, kind of an a la carte menu. A lot of times these practices build upon each other, and that's where you can discover the real cost savings and benefits. And so that takes significant time and investment by the farmer in figuring out how to change that in a way that works for their own operation. So as we shift to focus on the lenders, you know, I've just spoken about the growing body of evidence about the financial benefits of resilient agriculture. And yet we see a disconnect with the current loan offerings on the market. And I have to note that, you know, lenders do include costs for conservation practices in, you know, regular operating loans that they currently use. But there are still several disconnects between the financial profile of resilient agricultural practices, which we just discussed, and current loan offerings. And that can create disincentives for farmers who want to adopt these practices. So the first one is information gaps. One of the great things about when we did our farm budget work was the interest by ag lenders. They wanted to see more farm budgets that were looking at the impacts of conservation adoption. They wanted to see it over a longer time period. So while that evidence is building, I think there's still a lot of room to do more, and also to make sure that lenders are seeing the information that's already out there. Second is the short-term focus. So most operating loans, production loans, are done on an annual basis. And that can cause lenders really to just focus on the short-term repayment potential of the farmer rather than their desire to maximize their long-term profitability and resilience. And then last, just the fact that, different loans terms don't align with the financial needs of the farmer through that transition. So if you look at it as, maybe a 3 to 5 or potentially more year transition, having lending products that align with where you would expect the farmer to be in that financial transition would really help them make it through. And I should note that lenders can't tell farmers what to do. They don't farm for farmers. They can't promote specific practices. But there are a bunch of example products and programs and examples of them already creating things that take a more proactive approach to important issues. So one are the kind of long-standing Young, Beginning, and Small Farmer programs. Farm Credit does these, as do some other banks. They often include business planning and credit enhancements that allow these firms to grow over time. Another are some recently announced organic transition products. Rabobank had one last year, and then Compeer Financial also had another one. And those basically align with that 3-year transition period for organic farms between when they start farming organically and when they achieve certification and are able to get the price premium. And then another one to be aware of is the Farm Service Agency has a conservation loan program, but from what we can tell, it has not been used very much. So that's kind of an interesting area for continued exploration to figure out why that's not being utilized and if it can be improved. So from our research and from our conversations with lenders over the past several years and other experts in the field, we've come up with 5 lessons or kind of guidelines for thinking about how to design modified products or programs to finance more resilient agriculture. So first is to better understand the financial benefits and barriers to agriculture, resilient agriculture. And that's, what we were just talking about, really understanding that financial transition and what problem you're trying to solve. Second would be to design the loan structure and requirements to correspond with that profile. Then this is a topic that we could talk about a lot more, perhaps in the Q&A, loan support. So if we're in a situation where a lender is interested in designing something new, but perhaps does not yet have the data that's required to modify their credit processes, loan support can help bridge that gap. And it can take a variety of different forms. And in the report, we've got a table comparing some of the different options. But it can be everything from very simply, an external third partner helps buy down an interest rate for a little while. It could be a contract for production that takes out some of the risk for the farmer and then therefore for the lender. It can also be things like loan guarantees and subordinated debt. There are a lot of potential areas for collaboration here, but we really emphasized that if we're going to use loan support, we need to use it for a purpose and not just to kind of create a subsidy that goes on forever. So that loan support really should be helping to collect data on the financial and environmental performance of the new product and of the practices in order to show results, fine-tune the program, and ultimately the goal would be to adjust credit ratings. And finally, we can't pretend that lending happens in a vacuum. Farmer decision-making is complex. And so as you're moving forward on something like this, it's important to consider other forms of support that farmers may need to ensure successful practice adoption. Maybe that's a peer network. Maybe it's technical support. Maybe, like we said, it's a connection with with the buyer of their products. And so that's going to be something that needs to be considered. The other thing would be making sure that you have a strong partner who's helping with the environmental and financial data collection. So now I'm going to move into the 3 recommendations that we had in our report. So first is to assess climate risk at the lending institution level. And so what's exciting about this space is that the financial sector writ large has made significant progress here. And so there's actually a good amount of resources that lenders can learn from as they kind of get up to speed on best practices. And we included 2 appendices in our report, and one of them had a variety of resources on this topic. And then I think the other conversation to watch is the one that's unfolding around the CFTC subcommittee report, focused largely on this issue. So second is to understand the role of resilient agriculture in managing climate risk. And this is another great area for collaboration. So one would be, depending on what region you're in, understanding, what are the relevant climate risks and what are the practices that can help farmers mitigate those risks. Then moving on to understanding, what's the financial profile, what are the benefits and the costs over time of adopting those different practices. And also familiarizing yourself with assessments of that financial value that already exist. There's also an opportunity for, lots of collaboration around data collection. But one thing that I do want to emphasize and caution is to avoid relying exclusively on data sources that are only used by one segment of farmers. So for example, if we're going to rely on farm management software, we have to know that only larger farmers, typically use that to much higher rates. And we could have a big blind spot to the expertise and the experience of smaller farmers. And so that's one thing that I wanted to raise to make sure that we don't continue emphasizing blind spots that may already exist in the system. And then the last recommendation is around actually designing those lending programs or products that support farmers in building climate resilience. And so, in this, it's important to incorporate data on the benefits of resilient agriculture, ultimately into credit rating. Consider the financing needs of farmers who've been historically underserved, whether it's farmers of color, women farmers, or smaller farmers, by lending, and making sure that as we design these programs, we don't make those gaps even larger. And last, it's also important to know, as lenders and farmers exist in this broader system, that lots of food companies are making sustainability targets, and there's a nice synergy here of the types of goals that they have and the potential for lenders to play a role in helping them meet those goals. And so there's a lot of opportunity, especially for lenders who are financing both food companies and farmers, to be thinking about the connections there. The other resource I wanted to mention, so we have the appendix on climate risk assessment, and we also have another appendix on analyses that have been done on farm budgets, taking conservation adoption into account. So both of those are good places to start as you dig more into this topic. And with that, I will pause and ask for questions.
We have one question from Cody. Are there some lenders out there who have embraced this ideal of lending to conservation-minded farmers?
So yes, and you have to say, first of all, that some lenders have been supporting conservation activities in different ways for many years. For example, the farmer who wrote our foreword Dick Whitman spoke about how Northwest Farm Credit would help sponsor breakfasts, peer-to-peer breakfast networking groups with farmers who were learning about direct seeding techniques. And that was, many years ago that they were supporting that. More recently, I think, the real nut to crack is whether this can actually be incorporated into the business model and seen as critical to the future of our agricultural system and therefore lending businesses. So more recently, I see those agriculture transition loans as really good steps forward and the type of innovation that I think we need to see on broader resilient agriculture issues.
Great, we have lots of questions coming in, so we'll get to them one at a time. Were you able to identify any regulatory changes needed on the banking side to move the needle?
That's something that we're still tracking down. So there is a subjective component to lender assessments of risk. They rely on the 5 C's, which I'm not sure I have memorized, but one of them is character. And so, in all of those, there's a bit of a subjective component in how lenders are assessing their risk and the types of loans that they do. And yet they also have pretty strict regulations. And so figuring out, what they can do under the current regulations, what regulations may need to be adjusted. And then also I'll again emphasize that role of loan support. If there's something that a lender is interested in trying, but doesn't yet have the data to prove the case to their regulator, engaging with outside collaborators who want to provide loan support could be a really interesting kind of middle path to prove the case that something can stand on its own. I'm
loving the interest here. We've got comments and Q&A coming in. So we'll just make our way through these. I'm going to tie these two together, Maggie, because I think maybe you can answer the first one quickly. What is the first step a lender should take in engaging in financing resilience? And then sort of separate, is there talk of tying crop insurance to sustainability targets to drive adoption of conservation?
Great. So I think the first step that a lender should take is, what I mentioned, one, first understanding what the climate projections are for their area and what impacts farmers that they work with already are experiencing right now. And then understanding the types of practices that farmers can adopt to build their resilience to those impacts. And then I think a really important role for lenders is to collaborate in helping to identify the financial impacts of those practices. Lenders often look to universities, like land-grant universities, for this kind of analysis. But I found that there's just not enough of a two-way exchange to know what information do farmers and lenders need for their decision-making, what information can external researchers provide. And part of the goal of this report was to better facilitate that exchange so that lenders can have a better understanding of that financial transition, the barriers and the benefits. Then I think, the next step is the hardest one, is figuring out how the lender can actually change to better facilitate that on behalf of the farmer. And that's the one that's going to require the most work, but also that I think can have the greatest impact. And you also had a question on crop insurance. So yes, there's also interest in working on crop insurance policies and rates and figuring out how to make sure that crop insurance also has the right incentives for more resilient agriculture. The Agree Economic and Environmental Risk Coalition, of which EDF is a member, is doing some really great work on that, which I would encourage you to check out.
Great. I'm going to try to do another combo. There's some great questions coming in here. How receptive beyond Rabobank and Compeer have other lenders been to considering this type of analysis and new lending products? And there was one related to that about how lenders can make sure that they aren't offending farmers who already believe themselves to be good stewards of the land, which is a great question.
So first on how lenders' reception. So I think it varies, of course, by lender. It also differs depending on, what we're talking about. So I found that lenders are very interested and receptive to getting more farm budget information on these practices, very interested in educating themselves on this. And again, I think that's a great area for future collaboration and educational efforts. Then when it comes to, okay, well, can lending practices be changed to accommodate these kinds of transitions? What you hear a lot of times is, of course, first that lenders can't promote specific practices. And so that's why I was very clear in the report and also here that they don't have to, but there are already examples of programs and products where they do take a more proactive approach that I think are very relevant to this issue. For example, young beginning small farmers, Farm Credit has that in their mission to promote that category of farmers because you need young and beginning farmers for the future of agriculture. I would argue similarly, you need agriculture to build its resilience for the future of agriculture. So I think if we can get into that mindset of seeing this not as a choice, but as an imperative for the future of agriculture, then I think that we can have that mind shift and figure out more creative ways to make this fit within, what's required of the regulations, but also moves everybody forward.
Along those lines, there was a question about the organic transition product as an example of aligning loan products with conservation practices. Can you talk a little bit more about what that looks like?
So there are two out in the marketplace, one Rabobank, one Compare that I'm aware of. There may be more. And basically it allows the farmer to spread out over that 3-year period to spread out their repaying that debt. And so we'll have to go back and check on this in the report, but my understanding is I think they may pay interest only and then they pay the principal once they achieve organic certification. I'll have to check on that, but it does, it allows them to move their payments over time so that they're not paying as much when they are not making as much, and then they're paying more once they achieve certification.
Is there research or resources available for connecting the financial and environmental resilience of farmers to the resilience of the rural communities they're a part of to help demonstrate the triple bottom of sustainable ag products?
Oh, that is such a good question. And it's one that we're really interested in to look a bit more broadly at watershed level resilience, because we know that farmers can also adopt practices that not only improve their own resilience, but also that can contribute to the resilience of the overall watershed by holding back water, potentially in flooding situations. And so I'm not aware of those case studies. I hope that they exist, and I would love to see any that are out there. So I'm happy for that question. It's really a really great topic.
A few more on crop insurance. If we heard you correctly, approximately 50% of farmers have crop insurance. Do you have an estimate of the proportion of U.S. farmland covered by federal crop insurance?
So that was 15% of all U.S. farmers. I don't think I have the acreage, but we do know that about 85% of all payments go to just a few crops, which are the major grain crops. So I think if you looked at a map, you could probably assess that. And then also there's a question of there's the acreage that's covered, but also the level of protection. So for example, a lot of farmers in California will just have catastrophic levels of crop insurance rather than the higher levels that you'll see in the Midwest. So there are a bunch of different nuances in how we define crop insurance protection. And the main point there is just not to assume that crop insurance is all we need, because there are a lot of gaps in that system. And also it was never designed to be the only risk management tool.
To that point, expanding a little bit, what are your thoughts on a crop insurance type program that works more like a conservation transition program to overcome adoption barriers? So it's more proactive versus reactive.
A crop insurance program that would act like a transition. I'm not sure. I mean, I do think there's potential for, we see it in other insurance sectors, like car insurance is the easiest example. Like if you're a safe driver, you get lower rates on your car insurance. That's at a very high level, but I think you could see similar aspects being built into our federal crop insurance program.
Did you identify any barriers within conservation financing and the fact that a large percentage of land that is rented and not owned directly by the farmers?
Sorry, Chandler, can you repeat the question?
Sure. Did you identify barriers with the conservation financing considering so many farmers rent and do not own the land?
Yeah, that's another really important question. For this report, we decided to focus just on lenders. But I think that is also a really significant part of the system. And in our report in 2018 that looked at kind of the broader farm financial system, we included a big segment on landowners and absentee landowners. I think, I have lots of thoughts on that, but I guess all that I'll pull out right now is just that we're not saying that agricultural lenders can solve this on their own. We're saying that they have a role to play. Just like crop insurance has a role to play, just like, grain buyers have a role to play, and landowners do certainly as well. As a community, we have to think about this entire system. And the intention of this report was to tease out what that role may be for lenders.
Can you direct listeners to the documentation of reduced fuel, labor, and equipment costs from no-till and confirm that those reductions are not offset by cover crop management?
Yeah, so two resources I would point you to. One is the report that we did in 2018, Farm Finance and Conservation, which gets into that. And we did that in collaboration with agriculture accounting firm Keiko Isom. And so they were able to pull from their, full kind of field of accounting clients to document those trends. And then we also looked at it specifically with 3 case studies. Then the other resource, which I think is great, is the SARE Making Cover Crops Pay resource. And especially because you asked about the relationship between cover crops and no-till. And it's true sometimes, no-till is essentially some of those savings would go towards the cover crop seed expense if you're doing that integrated system. And so I think sometimes it's important to take a step back and think about, how the practices interact and what the overall potential for cost savings and resilience over time are, and recognize that, cover crops cost money. And so there are ways to either maximize your cost savings through different things that happen on the farm, or look also towards that, towards government payments or return side and yields to figure out how you can make that whole financial equation work.
So we're hearing that many farmers are already over leveraged and reluctant to take on new loans. Are there other mechanisms beyond loans to address these issues along with the issues of equity and risk mitigation?
Yeah, definitely. And that's an important point. And also one that I would say, we're not suggesting new extra loans for conservation expenses. We're suggesting that farmers' existing loans be reconfigured to better align with that transition. So we're talking about, an operating loan that could replace the farmer's existing operating loan, not, increasing the overall debt load of the farm. Then aside from that, it's also important to note that since the lender has that holistic view of the farm's finances, any other additional revenue that the farmer can bring in also bolsters that case for the lender. So these things work together. So whether it's, cost share payments from government, whether it's, increasing environmental credit payments, like things like the Soil and Water Outcomes Fund that we see in Iowa, there are different ways to then add to that bottom line and make the whole package much more attractive.
Another two-parter. Can agricultural lending institutions learn from actions taken by mainstream banks on climate risks? And also, how can they provide more training or seminars for their clients? Do you see this being done, such as the example that Dick Whitman provided?
So there's definitely a lot that agricultural lenders can learn from mainstream financial institutions. Several banks have done this kind of climate risk assessment. There's some open source tools. And many of the larger banks that have done this kind of assessment, have some footprint in agriculture and some footprint in other sectors of the economy. And they have found that a lot of the risk that they are seeing is in their agricultural footprint. So, I think you can learn from those aspects, but then consider that those tools will certainly have to be tailored to work well for the different types of banks in U.S. agriculture. And then I think that the other question was about education. So that's one area where I'm really looking to collaborate with others moving forward. I think it's been great that we've garnered a lot of interest through this. And we work collaboratively with a lot of the different organizations that are doing these kinds of farm budget analyses. And I think there are some very great opportunities to do lender education, especially since we're largely in a virtual world right now. We can have experts from everywhere contributing to that. And I think that would be very valuable because from talking with lenders, many of them are not aware of the resources that are out there.
So many great questions. Another one from Rod. Have you had an opportunity to discuss the added value of conservation practices with appraisers and the effect that it can have on land and collateral values?
We have had conversations with appraisers, and we're still honestly figuring out a path there. What the appraisers have told us is that, they follow the market. So it has to show up in the marketplace first before it would be incorporated into appraisal. And while I've heard of some anecdotal examples of land getting a higher, purchase price because the soil was in a really good condition, and intuitively it makes so much sense that it would, I'm not sure yet of the data that's there to prove that at scale. So that is another great topic and an issue that we're really interested in pursuing further.
Are there regulators or politicians considering tax credit programs for farmers committed to a transition? And do you see the current ag banks as the most promising, or do you think new financial institutions are needed?
These are such good questions. So on tax credits, yes. So we published another report last year with the National Association of State Departments of Agriculture that looked at innovative state-level approaches to financing conservation. And tax credits were one of the things that we looked at. And that could be a potentially good handle, especially for the landowner segment. But I will note that in COVID times, getting additional tax credits is going to be really tough. So that's just another thing to be aware of. And then, sorry, Chandler, what was the second half of that question?
Sure, sorry. Do you see the current ag banks as the most promising, or do you think new financial institutions are needed?
I think there's room for both. We're going to be putting out some work soon that showcases some examples of how catalytic capital is working in this space, and a variety of kind of new innovative financial structures that are being built. The reason that we wanted to focus on mainstream agricultural lenders is because that's where farmers already have their money. And we think that they have a really important role to play in this whole conversation. So, I would say both. I think it's great to have new innovative models out there, but we also need to see, our mainstream sectors and finance providers moving.
I'm seeing we have a few great comments and resources available. Some I'm seeing are available to all attendees in the chat. Just remember, if you'd like to share a comment or resource with everyone, to be sure to click the drop down to share with all panelists and attendees. Do you foresee federal crop insurance programs building in compliance with resilience practices to increase adoption?
Do I see crop insurance building in compliance?
Mm-hmm.
Is that the question?
Yeah.
I'm not sure. You know, I don't think I have a crystal ball on that one.
Do current poor working capital conditions on farms make financial support for resilient practices even more important?
I would say so. You know, it's important to understand that this potential work is taking place in, you know, on a severe farm economic crisis. And that kind of requires us to tread more carefully, but also to know that, you know, any support in helping farmers become more profitable and resilient over time is all the more valuable.
Do you have any information on whether premiums could be paid by commodity buyers for the use of conservation practices?
You know, premiums in commodities are tough. We are seeing, you know, more kind of interesting different market segments that are sometimes incorporating premiums. But, you know, in areas where perhaps a commodity purchaser has a sustainability goal, and if they're not willing to pay a premium, that doesn't mean that they're not investing. So I think we need to look at supply chain investment with a broader lens. You know, they may be offering cost share, they may be offering technology trials, they may be offering technical assistance. So there are a variety of ways, you know, as we kind of see the supply chain sustainability evolve, there are a variety of ways that they are investing. Some of them are buying environmental credits. And so I think we just need to keep an open mind to those different forms of potential increased revenue or support that can come to farmers from those sources.
Great. I did want to share one comment. I see Wayne Fredericks, a farmer.
Hi, Wayne.
Hi, Wayne. I only know Wayne from our blog. He's infamous. But Wayne said lenders are the second most influential partner in a farm operation next to the spouse. Simply their openness to building a resilient system would be huge. Thanks for that comment, Wayne.
Thanks, Wayne.
Another question, do you see carbon credits playing a role to de-risk banks and help farmers transition to conservation practices?
I think they could. So, you know, the way that I think about it is right now with the current financial system not aligned to create incentives for more resilient agriculture, that means that a carbon credit essentially has to work harder because it's swimming upstream. Ideally, we would better align our mainstream financial system with the, you know, the real financial value of resilience practices over time. And then something like a carbon credit is icing on the cake, makes the financial picture for the farmer much better, and everything would be pushing in the same direction.
One of our participants knows someone who's trying to transition to a different type of farm production. Would this be supported by our program?
I'd have to know more of the details and also note that we don't have a program yet, but you know, if any lenders are listening, we'd love to collaborate with you on that. But that's the type of transition that we're looking to partner with folks to support.
I'm scrolling back and making sure I didn't miss any. I don't believe I asked this one. Do you have any data or information about climate change and the risk of animal farming?
Yeah, you know, I would point you back to the fourth National Climate Assessment, which is a congressionally mandated report, super comprehensive, you know, done by the federal government, very good, and it points to risks to agriculture in all different types of agriculture. So I think when we think about livestock, you know, heat is a really big issue. I remember that being called out in particular, and I'm sure there's more detail that's in that report.
think the fire hose of initial questions has officially slowed. If I have missed any, that is my fault. So we'll capture them in the notes and follow up with everybody. Unless there are any final questions coming in, I think Maggie, you can close.
Well, let me just say thank you to everyone who tuned in. This was really great attendance. My email was on that last slide. You should know how to reach me. So please do be in touch if this sparks any new ideas. And we really appreciate your time.